If you have ever watched a trade go up 10%, 20%, maybe even 40%, and then somehow ended up selling it at break-even or worse, this video is for you. Most traders think their problem is finding better stocks, better entries, better indicators, but for many retail traders, the real problem is much simpler. They know how to buy, they do not know how to sell. Anyone can press the buy button. The hard part is knowing what to do when the trade starts moving. Here is the symptom most traders recognize. You only sell on a downturn. You buy a stock, it works, the chart moves higher, your account is green, you feel smart. Then instead of taking any profit, you move the goalpost. You tell yourself, it looks strong, I will wait for more. Then the stock pulls back. You say, it is just a dip. Then your winner becomes a small winner, then break even, then a loser. Eventually you sell, but only because the market forced you to. That is not an exit plan, that is a reflex. The first mindset shift is this. Every trade has two exits, not one. The first exit is the stop. That is your risk exit. It answers the question, where am I wrong? The second exit is the target. That is your profit exit. It answers the question, where do I start getting paid? The stop is about weakness. If price proves the trade wrong, you act quickly. You do not negotiate. You do not hope. The target is about strength. If price moves in your favor, you want to sell into demand, not panic into weakness. Sell weakness fast, sell strength patiently. Mistake number 1, holding losers too long. You bought at 100, it drops to 95. You tell yourself it will come back. It drops to 90, you average down. It drops to 85. Now you are hoping instead of trading. The stop existed for a reason. When you ignore it, you turn a small planned loss into a career-changing one. Mistake number 2, selling winners too early out of fear. You bought at 100, it goes to 105. You are terrified it will drop, so you sell. Then it runs to 120. You feel like a genius for the 5% you captured, but you missed the real move. The problem is not that you took profit. The problem is that you took profit based on fear, not based on a plan. Mistake number 3, having no exit plan at all. You buy a stock because it looks good. You have no stop, you have no target, you have no idea what you will do if it goes up or down. You are not trading, you are gambling and calling it analysis. Every professional trader defines their exit before they enter, not after. Here is the professional framework. Bracket your trade before you enter. Before you buy a single share, you need 3 numbers: your entry price, your stop price, your target price. Example, you have a $50,000 account. You risk 1% per trade. That is $500. You want to buy a stock at $100. Your stop is at 95. That is $5 of risk per share. 500 divided by 5 equals 100 shares. That is your position size. Your target is 110. That is a 2R reward. If it hits, you make $1,000. Entry, stop, target, position size, all defined before you click buy. The stop is non-negotiable. When you place a stop, you are not saying the stock is a bad company. You are saying, at this price, my idea is wrong, and I need to live to trade another day. William O'Neill's CAN-SLIM framework teaches cutting losses at 7 to 8%. Many professional traders use similar hard rules. The exact number matters less than the principle. Small losses keep you in the game. Big losses end your career. Now let us talk about winners. A winning trade should not be treated like a losing trade. With losers, you sell weakness fast. With winners, you want to sell into strength. That means you can place resting limit orders near your target, where other buyers are still willing to pay up. You are not trying to guess the exact top. You are trying to get paid while demand is still present. A simple model: sell a third at the first target, sell another third if the stock extends, trail the final third with a moving stop, take something when the market gives you a gift, then leave enough on the table to participate if the trade becomes bigger than expected. One of the most practical rules is the 2R trim rule. If your trade reaches twice your initial risk, take partial profits or raise your stop to break even. Example, you risk $5 per share. At 2R, the stock is up $10. Sell a third or a half. Move your stop to break even on the rest. Now you are playing with the house's money. The worst outcome is a break-even trade. The best outcome is a home run. In growth stock trading, a commonly taught rule is to take meaningful profits when a stock rises 20 to 25% from a proper breakout. Most breakouts are not monster winners. Many run 20 to 25%, then correct. If you never take profit in that zone, you may keep watching good trades turn into memories. This does not mean you always sell all of it. It means you take something off the table. Trim 33 to 50%. Keep a core position only if the stock remains a clear leader. Here is the exception that separates basic selling from professional selling. If a stock breaks out and gains roughly 20% or more very quickly, often within the first few weeks, it may be showing unusual strength. Some traders give it more room and hold for at least 8 weeks. This is not the default. This is an exception for stocks that explode out of a proper base with institutional-sized volume. Fast strength is information. It may mean big money is building a position, but you still manage risk. If the stock breaks badly, you respond. There is one important exception to partial profit taking. If your position is very small, trimming may not make sense. If you own 5 shares, selling 1 share here and 1 share there can make the plan messy without improving the outcome. For small positions, the decision is cleaner. Hold the whole position according to your plan, or sell the whole position when the plan says the trade is done. The goal is not to look sophisticated. The goal is to make decisions you can actually execute. Moving averages can become exit rails for swing and position trades. The 10-day line works for fast momentum trades, the 21-day for short to medium swings, the 50-day or 10-week line for position trades and leaders. If your stock closes below your key moving average on heavy volume, the trend may be changing. That is a signal to reduce or close. Moving averages are not magic. They are a way to define whether the trend is still behaving. If a position has been up meaningfully and then returns to entry, do not let it become a full loss without making a decision. You bought at 100, it went to 115, you did not trim. Now it is back to 100. Once a trade has given you a real gain, break-even is no longer neutral. It is a warning that demand has faded. Either close it, trim it, or rebuild the trade around a fresh setup, but do not just hope. For investors and position traders, price is not the only sell signal. If the reason you bought the stock is no longer true, the position deserves a fresh decision. Earnings growth breaks down, guidance is cut, the company loses its industry leadership, the sector turns against the stock. If the thesis is broken, the chart does not have to collapse for you to act. You can reduce or exit while the price still has buyers. Now let us put it all together into a checklist you can actually use. When you are holding a stock, there are only 3 decisions: hold it, trim it, or close the counter. Here are the first 3 questions. 1. Is the stock below your stop? If yes, close it. The trade is invalidated. 2. Has the stock reached 2R or your first target? If yes, trim a third or a half, then raise the stop on the rest. 3. Is the stock up 20 to 25% from a proper breakout? If yes, take meaningful profits unless it qualifies as a true leader. 4 more questions. 4. Is the stock breaking the 21-day, 50-day, or 10-week moving average on heavy volume? If yes, the trend may be changing. Reduce or close. 5. Has the original thesis broken? If earnings, guidance, sector leadership, or the chart structure no longer supports the trade, close it or reduce it. 6. Has the trade round-tripped from a good gain back to entry? If yes, do not pretend nothing happened. Close it, trim it, or rebuild around a fresh setup. The checklist is not meant to predict the top. It is meant to stop you from improvising under pressure. The whole point of an exit plan is to make the hard decision before the hard moment. Because once money is moving, your brain changes. When the trade is green, greed shows up. When the trade is red, hope shows up. When the trade reverses, fear shows up. That is why the plan has to be mechanical. Use resting orders when appropriate. Write down your stop before entry. Define your target before entry. Decide in advance whether you will take partial profits, trail the rest, or hold for a bigger move. The more you decide before the trade, the less you have to decide during the trade, and that is the entire game. So the next time you study a chart, do not only ask, should I buy this? Ask, where am I wrong? Where do I start getting paid? What happens if it goes against me? What happens if it goes in my favor? Anyone can buy, nobody can sell. The exit is the edge. Plan it before you need it. If this video helped you, follow for more trading education. Drop a comment with the hardest exit decision you have ever faced. I read every one.